All right, Bismillah. Time now is 5:09 p.m. EST. Today is December 25th, 2024. We're going to review some price action utilizing ICT concepts, those that work for me, not necessarily those that's in his arsenal, full arsenal. But that's it. We're going to review the ES utilizing ICT concepts. Today, the market was closed for obvious reasons. And so we're going to review Tuesday's price action. As we always try to remember to say our mantra day by day, and in every way I'm getting better and better. Day by day, and in every way I'm getting better and better. Just want to emphasize one key ideal or concept. I was going over these 6 thinking hats by Eddie DeBono, and the significance of the red hat to me, especially. I think as a culture, or as a whatever you want to call it, there's a lot of different reasons which will make a person not necessarily be in tune with their emotions. That includes overconfidence, confidence, lack of confidence. That includes fear, what we commonly call FOMO. That includes tilt, death by a thousand cuts, right? Entering, exiting trades, and greed, right? And greed, a lot of us don't really acknowledge greed because you think like that's a negative. It can be, right? Like every strength that you have could be like a weakness too, right? In the wrong environment. But greed is a difference between greed and seeking abundance. There's nothing wrong with wanting abundance. There's nothing wrong with not wanting to be in a state of lack or a state of want. So just wanted to drop that. And again, the 6 thinking hats helps to improve your decision-making skills, utilizing each hat as a different approach to decision-making and covering the entire spectrum of the problem or the situation from different perspectives. And we have the 7 Fundamentals of One Good Trade by Mike Belfourier. The book is by the same title, One Good Trade. And his economic calendar. Tomorrow we have high impact news, unemployment claims, and we have moderate news, crude oil inventories. All right, so on Monday, we outlined this 4-hour breaker. My gosh, fat fingers. Yeah, I identified as bullish breaker. All right. I think the only thing that's on the chart on this time frame that wasn't there previously is the quadrants of this sell side imbalance, buy side inefficiency from Wednesday, December 18th, FOMC day. All right. So we have low, high, lower, low. We have a breaker block here. Price trades above it, retraces back into the consequent encroachment of the breaker, or should I say mean reversion. Let's just say the halfway point, right? The halfway point of the breaker. And then takes off. Breaks this relative equal high, or takes out this relative equal high and literally holds above it, consolidates. It breaks this high, this relative equal highs, and then consolidates above it, and eventually takes out Friday's high, 75% of this SIBI, and potentially could continue going higher above this consolidation. And this would be that would be a completion of a buy model as well. This is the original consolidation. But we'll see, because we have an inverted, you know, that's my favorite, right? We have an inverted 4-hour fair value gap here. Terrible. All right, so we have an inverted 4-hour fair value gap, and you can see how that played out here. Drop, and then we pushing back up into it. So the price trades into it, then we look and see if price is this going to be major resistance, or will it be resistance turned support. So that's that. We want to see what happens at 6 o'clock too, right? Is it going to gap up into here? Is it going to gap down? Is it going to trade? Is it going to like not make any like relevant gap? But we'll see. All right. So I was, and this is that 15-minute inverted fair value gap, a bearish fair value gap turned. Bearish fair value gap turned inverted, right? Because it was sending price down here, price reacted to it, broke through, and then held above it. And one of the characteristics of an inverted fair value gap is that it's a change in the state of delivery. Change in the state of delivery. So once that happened, we have consolidation above this level. I think also what I highlighted was Monday's high and then Friday's high. And you can kind of see that price, once price traded above this level, before hit Friday's high, resistance, pull back down into Monday's high, and took off. Right. Also traded into the midway point, consequent encroachment of that 4-hour CIVI that we outlined. All right. So another point is, so what time is this? This is 3:15. This is the London kill zone. So this is an optimal trade entry. This is optimal trade entry that's utilizing the Asia range, how I identify it. So in this case, I'm using this high here and using this low, and this high, this low, price retrace into it. But this is on this time frame, this wouldn't be a trade I would take, like this trade right here, right? You can, obviously, right? But it's outside of the kill zone. You should try to, I wouldn't take this trade unless I was like on one, right? Like like this rushing and trying to this trading for the sake of trading, right? Like that's how you get clapped, right? Because you're not following your own rules. But here, this is where I'll be looking. I'll be looking for this to happen, breaking market structure. So let's take that off. So we'll be looking for price to break market structure here in this level. So anticipating market structure shift. So my A+ trade setup, and it has some caveats to it, I guess. But we want to keep things as simple as possible. So we want to see a run on stops. 2, we want to see a market structure shift. 3, we want to see a pullback or a retracement into the price leg, into an inefficiency or PDRA. premium discount array, pull back into an inefficiency or PD array on the price leg that caused the market structure shift. It's 3 rules, man. Keep it simple. Keep it super simple, right? Keep it simple, stupid, right? KISS method, right? And what I mean by the caveat, like, or nuance of the this A plus trade setup is that, oh, that's the next, a pullback into an inefficiency or PD array that's at least 50%. That's at least below 50% of the range. Dealing range. And that's going to be on the price leg that caused the market structure shift. That's it. Those are the rules. All right, keep me honest, right? So if it's below 50%, but it doesn't draw down to 61.8 or below, then obviously it's not an optimal trade entry, but it's still a solid entry based off a different model, right? So this is that model. If it's below 50%, but trades into the 61.8, 78.6 range on the Fibs, then that becomes a different model, an optimal trade entry model. That's a preferred model, but it's not the only model. So those are literally the only 2 trades that I'm looking to take. All right, so here we're looking for a market structure shift here, ideally during a kill zone, right? So we have the shift here in this price leg, right? We kind of have the run on stops here with this here. Have run on stops, these relative equal lows here. Then we have a push higher. And remember, this is that 15-minute inverted fair value gap that's holding strong. So we have a lot of reasons. And again, our premise is not only the last video we walked down from like the weekly, use a PD array there. Daily, we use a different PD array. We went to the 4-hour, utilize a different PD array. And again, this is a bullish breaker here. Bullish breaker, low, high, low, low. Then we have a break in market structure here, pull back into the breaker. And then took off. I think on the other video, so probably wondered like why did I not utilize? So here, this wouldn't meet this criteria here, right? But this order block, breaking this order block is a change in the state of delivery. Similar to breaking below here is a change in the state of delivery, because this is an inverted fair value gap, right? So even if you say use the bodies, this is something you have to do. Like if your trade setup's like, oh, this doesn't meet that criteria, so why would I go long here? In the previous video, I actually used the order block. And then you could go, when you go down, it's actually not an order block. It's actually, I think, a breaker. Right? And that's also like changing the state of delivery, right? Once it broke, right? So I think in the 1 hour, it's a breaker too. So that's the logic, right? So it's like a hidden OTE entry here. The low here would be 59.65 and the optimal trade entry. Let's put some words here. Change that to 10. Oh, is it time to change that yet? Yeah, it is. All right, good. 10 to the right and to the right. And optimal trade entry long, and it hit target 2. It hit target 2. What's the high on this candle here? 60.99.50. Almost 1.25 1.25 ticks, 1.25 points here. That's fine. That's good. That's a good ratio. Ideally, we're still looking for one standard deviation, but you would have scaled out. Target 1, scale out here. This is first target, second target. Looking for price to ideally trade above this consolidation to complete a market maker buy model. But we'll see, right? Back to the 15-minute. Chart getting noisy, right? Let's take that off. That was kind of like a tangent, right? And I think, all right, we discussed that. I'm going to take this off now because that doesn't serve any purpose to me right now. And so this was one entry here, optimal trade entry long, and this one, and that's just looking to take out the intraday high, the London high, and take out the previous day's high as a target. Then it pull back in during this time frame. So we have our market structure shift here. Boom. Let's so that would be an entry into this fair value gap. You don't really need the fibs once you kind of use it a lot. It becomes like, oh, that should be about 50%. So that's why like the ideal of eyeballing optimal trade entries is ideal. You don't really need that. That is a level of precision, but it's also something you can get used to without seeing it outlined on the charts, right? Like you don't need the crayons, right? You can just see it. Ideally, you want to get to that point where you just see it, but do what you got to do to be profitable. We are at the 17-minute mark at this time, so I'm going to try to speed things up so I won't make this video too long. And we are at the consequent encroachment of that 4-hour SIBI, sell side imbalance, buy side inefficiency, all that FOMC candle. And you can see it was resistance turned support, and then price shot up higher. So we have one entry here, target in here. We have a pullback. Was there any news on those days? No. Okay. All right. So we have a pullback. So we have a break in market structure again. Then we have a pullback. Yeah, again, if you utilize order blocks, you don't have to. There's one here. That would have been the order block here. There's another order block here. And let's see. Let's play the eye. You can play the eyeball game, but it should hold above 50%. Literally hit the mean reversion of this order block. And this entire 2 down close candles is the order block. So if you wanted to do that, you can do that. But I prefer, I don't know. There's like, it's hard to explain why would I choose just the one candle over the 2. But anyway, I would choose the one candle in this situation. And it may have something to do with the range, right? I think that's what it was. I don't know why I got stuck there, but the overall range, you're looking for it to go below 50% of the range. I'm like, yo, why didn't you show up over there? It's way over here. That's why. Let's see. Let's put that there. And what is it doing? Why is it not showing up? Crazy. Like, what just happened, right? It's not showing up anywhere now. Well, you guys know the model. You guys know the model, man. I'm not gonna bother. Anyway, but that's the setup, right? So that's the range and price pull down here. Another entry would be here. I guess this is glitching for me. And there's another fair value gap. So on this time frame, one of the other aspects is trading from internal range to external range liquidity, and vice versa. Right? We can kind of see that on this time frame here, right? Internal range here. This SIBI, this BISI, break into external range liquidity, retracement back into internal range liquidity. Now, so what is external range liquidity? It's generally the swing highs and swing lows. Fractals, right? The swing highs, the swing lows. So this is external range liquidity. And the fair value gaps, the inefficiencies, the PD arrays like the order blocks, the breakers, so this is internal range. So we have internal range again, then we have external range, then we have a pullback again into internal range, into this order block or this order block. Yes, this can be considered a propulsion block, I suppose, but you don't have to get fly, right? And then so we have internal range, and now who knows, right? So we have engineer liquidity, we have external range liquidity taken, pull back, here, reclaim this level, pull back into this order block again, push higher, external range again. So where is it going? It may pull back here. We want to play that game because it's like, they pull back like this candle is going to close, and maybe it'll be here. Maybe ideally it'll be in this range here for another optimal trade entry to go higher, or a gap up here. Gap up here, maybe target the previous week's high, and now we'll complete the buy model we spoke of, or I can trade into here and then pull back into here. That would be a larger range. Because all of this now, even though it was great, it was great as like a level hold, and this is all targets now, right? This is relative equal lows right here, relative equal lows here, and we have this gap here, right? So this would be the range that we currently traded in, right here. 50% at this point. It's below this these relative equal lows. So we want to see what happens. We want to see what happens, right? Let's turn that off because it's annoying me. But all right, we at the 24-minute mark. So we covered the London session, optimal trade entry, or we covered this is not even New York session. So 9:30 here, 6:45. We got to push higher above the consequent encroachment of that imbalance, and then we have a pullback on this time frame. It doesn't look like a pullback, but you got a down close candle, right? So that's why I can go and anchor this to the top to the high of this candle, and then use this candle for optimal trade entry. If we're going to drop down to a 5-minute chart, and we can see it a little bit clearer. I want to get rid of this too. So we have, now you can see it on a lower time frame. An optimum trade entry long, and 1 standard deviation, 2 standard deviations, 3, and maybe it fell short of 3.5, but let's put it on a chart. Where art thou? Fell short of 3.5, but this is an excellent risk to reward ratio, just at 930. Even if you drew like, oh, wrong indicator. This is I think that's a 20-day EMA. Do the 20 up there, and you can see it's riding above. It's riding that. You have clear separation. If you put the 9 EMA, if you wanted to identify trend, let's see. I think that's the 20 here. That was the 9, right? Let's see. Like this is 9 and a 20 here. Well, you can change it to the 18, whatever you want to do, right? Clearly, now you're trading with trend. This is between 2 moving average. This is the value zone, right? So just utilizing moving averages. If you have that doubt, hey, am I with trend? Am I, the only one you're trading against in the market, you're trading against everyone. This is but your biggest enemy is yourself. The biggest enemy is you. You don't get any reward for just trading price action alone. This is also an entry pattern as well, anti on the modified MACD. Anyway, you don't get any reward for price action trading without using indicators. That's like the best thing for you to do is to kind of keep your chart as clean as possible and read price action. Or the alternative is you can actually be price action heavy and utilize indicators for confirmation of your trade setups. All right, so trend and momentum based entries. And this, you can do what you want, right? You don't need either of these two. I think the first thing I put on was like a Keltner channel, and you saw it right in the 2.5 Keltner channel. You can use on balance volume, OBV. It's also telling you a story, right? It's above this. I think that's a 20. That's also a 20-day moving average, right? And you see, this is also telling you that it's bullish. You don't have to, right? The core or the foundation of your trades should be, let's see what the VWAP or whatever does. Or yeah, like there's a trade strategy that S&B Capital teaches, like the 9 and the 9 EMA and the VWAP. You would have gotten somewhere down here. Or you could have just used, it's a lot of different ways. I know this is a lot of different ways. So you have this, you have a break out of this. I don't know the names of these things, so I don't care about it either. But you have this channel here. Or you can call it a wedge pattern. You have a break out of here, and you can enter as soon as it breaks this again. As soon as it breaks out of here. Probably got, and you wouldn't have got stopped out because your low should have been like, your stop order should have been like right here or down here. So you would have been good for that. But I'm just freestyling right now. But let's take that off. And I only brought these indicators in because of another mentor, which would be like Adam Grimes. He is also price action heavy, but he still promotes the use of like a Keltner channel and the modified MACD, for example. So you have nothing to prove, like, right? Money talks, and it don't talk to everybody. Like, you hear voices. I'd rather hear the cash register ring than hear people talk about nothing. Honestly, like, talk to me nice, right? Talk to me nice. All right, we at the 30-minute mark. I don't know. I had fun. I don't know if you did. Please like, comment, subscribe. Stay great.